China's real strategy isn't buying gold. It is quietly rewriting who gets to decide what paid means, and most of the market is still staring at the wrong scoreboard. The headlines want you hypnotized by a shiny object because it's emotional, it's visual, and it's easy to argue about. But the real conflict is happening one layer below price, in the rails, the liquidity backstops, and the rulebook that determines whether a transaction clears smoothly or gets trapped in someone else's jurisdiction. And the hidden mechanism almost nobody talks about is this. The growth of cross-border RMB activity isn't game T just trade invoicing anymore. It is increasingly tied to settlement for capital and securities flows, the kind of plumbing that determines whose balance sheet becomes the default bridge in a crisis. That's where the control lives. And if you stay with me, you'll know what to watch over the next 1 to 2 weeks, what kind of stress tells show up first, which levels matter in gold, the dollar, and offshore yuan, and what breaks, mechanically, if settlement liquidity tightens at the wrong time. Because here's the uncomfortable truth. Gold is the smoke, not the fire. Gold can surge for 100 reasons. Real rates, inflation expectations, geopolitics, central bank diversification, risk appetite whiplash. And yes, in the recent stretch, gold has been flirting with, and in some moments pressing through, record territory in a way that makes people feel like the reset story is finally here. But the market loves the clean story. China buys gold, dollar dies. Clean stories travel fast. Clean stories also get you blindsided. And that's where the real pressure starts. If you want to understand what's actually being built, you have to separate 3 different things that get mashed together on purpose: pricing, invoicing, and settlement. Pricing is the language on the label. Invoicing is the paperwork. Settlement is the moment money becomes final. When obligations are extinguished, collateral is released, and risk is actually transferred. You can price in dollars, invoice in dollars, and still change the entire power structure by settling somewhere else, through a different network, under a different legal umbrella, with a different liquidity provider standing behind it. That's not philosophy, that's market structure. And market structure is where power hides because it only becomes visible when something breaks. Now zoom out. Ask yourself, in a world where trust is fragmenting, what's more valuable? Owning an asset that might rise, or owning the pipeline that everyone must use to transact when stress hits? Owning the pipeline wins, because pipelines create choke points. Choke points create leverage. And leverage in finance is rarely announced. It's embedded in standard procedures, in who is allowed to clear, in whose collateral is eligible, in which payments get netted, delayed, rerouted, or questioned. But that's not the part that matters. The next detail is what flips the whole setup. The gold story is convenient because it reduces China's strategy to a portfolio choice, a bet, a trade, something you can chart and argue about on a weekend. But controlling settlement isn't a bet. It's an infrastructure strategy. It's about optionality under stress. It guesses about building a second route so that when the first route is blocked, or simply more expensive, trade and capital can still move. And if you want a single phrase that captures the difference, gold is an asset, settlement is a weaponized service. Here's how the service works in the real world. When 2 firms in different jurisdictions do business, they rarely send cash directly to each other in a clean, straight line. They rely on correspondent banks. They rely on clearing banks. They rely on messaging networks, settlement networks, and liquidity bridges. They rely on intraday credit. They rely on netting. They rely on someone extending a balance sheet so the payment can clear before the receiving party releases goods, securities, or collateral. In calm markets, that machinery feels automatic. In stress, it becomes a filter, and filters decide who gets through. So when people argue about whether the RMB is going to replace the dollar, they're asking the wrong question. Replacement is a headline word. Control is a plumbing word. China doesn't need the RMB to be the world's dominant currency for everything. It needs the RMB to become the default settlement option in specific corridors for specific counterparties, at the exact moments when the dollar-based pipes become politically risky, operationally slow, or balance sheet expensive. That's a narrower goal. It's also a more realistic one, and it can still change the game. Now let's talk about the hidden detail I promised, because it's the hinge. The popular assumption is that cross-border RMB is mostly about trade invoices, exporters and importers choosing to settle in RMB to reduce FX friction. That's part of it. But the higher control layer is settlement tied to securities and capital flows, things like investment settlement, bond transactions, portfolio flows, collateral movements, and the financing that wraps around them. Why does that matter more? Because trade is repetitive and price sensitive, but often low margin and dispersed. Securities settlement concentrates power. It concentrates liquidity. It concentrates risk management decisions inside a smaller number of institutions. And those institutions are exactly where choke points can be turned into policy tools, intentionally or defensively, And that's why the control of settlement story is live right now, not someday. We're in a calendar window where liquidity thins and balance sheets tighten. Month-end, quarter-end, year-end effects matter. Because banks and funds manage exposure around reporting dates, risk limits, and funding costs. This is when the invisible plumbing becomes visible. This is when small frictions become spreads. This is when spreads become price. Because if this one level breaks, the math changes. So what does the spread telling the truth look like in this context? It looks like funding pressure in the FX swap market. It looks like offshore-onshore price gaps that widen when access to settlement liquidity gets constrained. It looks like basis behavior, where the cost of swapping one currency for another under a specific tenor reveals stress. It looks like sudden surges in demand for very short-term liquidity. It looks like we can do the transaction, but only if we settle here, and only if we post this collateral, and only if we pay this premium. Those aren't headlines. Those are symptoms. And those symptoms show up before the dramatic price moves everyone tweets about. Now let's connect this to the infrastructure China has been building, because there are multiple layers, and each layer serves a different function. Layer 1 is a parallel settlement spine. You'll hear names like CEPs in this conversation, but the key is not the acronym. The key is the design philosophy. Don't try to replace the entire global system overnight. Build an alternative route that becomes indispensable on the days the main route is blocked, congested, or politicized. That's how new rails win. They don't win by being better in theory. They win by being available when availability becomes the scarce asset. Layer 2 is offshore RMB nodes, clearing banks and liquidity hubs that reduce friction for counterparties who want to settle in RMB without being physically inside mainland China's banking system. Every additional node reduces operational cost, reduces time, improves access to RMB liquidity, and critically, reduces dependence on a single route. It's the same logic as building more ports and more pipelines. Redundancy creates resilience. Resilience attracts flow. Flow attracts liquidity. Liquidity attracts more flow. That circular feedback is what turns a niche option into a default corridor. And that's where the real pressure starts. Layer 3 is policy geometry. Rules about how cash can move in and out, how overseas raised funds can be held, what kinds of transactions are encouraged or discouraged, and what settlement structures become normal for corporates and banks. If you control the rulebook, you can steer behavior without making dramatic announcements. You can widen a door. You can narrow a door. You can change the paperwork. Markets adjust. Slowly at first, then suddenly. Layer 4 is experimentation with faster settlement tech, multi-party settlement networks, and digital settlement pilots that aim to reduce intermediaries, shorten settlement cycles, and make cross-border settlement less dependent on the traditional correspondent chain. The point isn't magic digital money. The point is reducing choke exposure. When settlement finality can be achieved faster, with fewer intermediaries, you reduce the number of places where a transaction can be delayed, questioned, or blocked. That's why this is strategic, not trendy. Now, before the skeptics jump in, and they should, let's ground this with a reality check. The RMB is not the dominant global payments currency. It doesn't need to be for the strategy to work. Global share is a scoreboard that can stay low while corridor-level influence rises sharply. If a meaningful slice of energy trade in a specific region begins settling in RMB, if a chunk of Belt and Road aligned infrastructure procurement starts clearing through RMB rails, if a set of sanctioned or sanction-vulnerable counterparties move their settlement default away from dollar pipes, the strategic value shows up, even if the global pie chart doesn't look revolutionary. That's the trick. The map of influence is not the same as the pie chart of global payments, but that's not the part that matters. The next detail is what flips the whole setup. The flip is this. Settlement control is about who supplies the liquidity bridge in stress. In the dollar system, a huge part of the world's financial function relies on access to dollar liquidity, directly or synthetically, especially when risk-off hits, and everyone scrambles for the same collateral. That scramble is not emotional. It's mechanical. Margin requirements rise. Haircuts change. Dealers reduce balance sheet. Short-term funding gets expensive. And suddenly, the ability to settle becomes conditional. This is why stress events turn into dollar shortages. Not because people love dollars, because the pipes demand dollars at the exact wrong moment. China's strategy is to build an alternative set of pipes that reduces the conditionality of settlement for counterparties aligned with China's trade and capital orbit. It's a strategic insurance policy. It's also a way to shift bargaining power over time, because once you can offer settlement resilience, you can negotiate from a different position. You can bundle financing. You can bundle infrastructure. You can bundle payment rails. You can bundle commodity procurement. And you can do it in a way that makes the settlement choice feel like operational convenience rather than geopolitical declaration. That's how you scale something in the real world. Now let's stack proof, not as one chart, but as layers, because finance reality is always multi-causal. Proof point 1 is the steady expansion of alternative settlement participation. You don't need exact numbers to understand the direction. Any network that matters grows in nodes, grows in institutional participants, grows in operational scope, and grows in volume across time. The existence of consistent expansion is the signal. The point isn't that it dominates today. The point is that it exists at scale sufficient to be meaningful under stress for targeted corridors. And that's where the real pressure starts. Proof point 2 is the build-out of offshore RMB liquidity nodes. This isn't theoretical either. When you see additional clearing arrangements and more integration in major financial centers, that's infrastructure being placed where counterparties already transact. This lowers the activation energy to choose RMB settlement. In markets, friction is destiny. Reduce friction and you change behavior without needing ideology. Proof point 3 is the nature of cross-border RMB growth, shifting towards settlement tied to investment and securities flows. That matters because those flows are where margin, collateral, and risk management live. If a settlement rail becomes embedded in securities settlement processes, it becomes stickier. Corporates can switch invoicing currencies. Funds and institutions have settlement workflows that are harder to change. Once workflow changes, flow follows. Proof point 4 is corridor-based commodity settlement experimentation. Energy and commodities are where settlement strategy becomes tangible because flows are large and repeated. If a portion of energy trade between China and key counterparties settles outside the dollar chain, it reduces demand for dollar settlement in that corridor. It also builds competence and comfort. And comfort is the most underrated asset in finance. Comfort determines what people do under stress. Because if this one level breaks, the math changes. Proof point 5 is digital settlement experimentation aimed at reducing intermediary dependence and increasing settlement speed. Faster settlement isn't just a tech flex. Faster settlement reduces settlement risk windows. It reduces the need for some forms of intraday credit. It reduces the number of touch points where a transaction can be stopped. That's structural. Proof point 6 is policy and capital control geometry. How rules are adjusted to guide where money sits and how it returns. This is where control is explicit. Settlement is not just rails, it's permissions. It's governance. It's who can move what, when, and under what conditions. And those conditions shape adoption more than speeches ever do. Now, where does gold fit into this without turning into an overcooked conspiracy narrative? Gold is not the strategy. Gold is the collateral language. Gold is the neutral asset that carries no one's credit risk. In a world where trust between systems is being stress tested, neutral collateral becomes more valuable. That doesn't mean gold backs everything tomorrow. It means gold becomes more useful as a bridge, psychologically and institutionally. When counterparties need an asset, they can hold outside the promise of someone else's banking system. That S, why gold tends to catch a bid during periods when settlement and sanctions risks feel more salient. Gold is the asset you don't have to ask permission to own, and that is exactly why it gets pulled into these narratives. But let us be finance credible. Gold can also get slammed in a heartbeat even if the long-term thesis is intact. A spike in real yields, a sudden dollar squeeze, forced selling, profit-taking into year-end, options-related flows, any of these can whip price violently. Trend signal and noise are not the same. If you can't hold that distinction, volatility will use you as fuel. And that S, the psychological trap most people fall into, they confuse price motion with narrative truth. Price moves are often positioning, and liquidity first, narrative second. So here's the psychology shield, because you need it if you want to survive watching these markets in real time. Volatility is not just random, it's a tool. It flushes weak positioning. It triggers stop cascades. It forces emotional decisions at the worst possible moments. The media amplifies it by attaching moral certainty to every candle. Up means confirmed, down means debunked. That's how retail gets chopped up, by being trained to react to the last 10 minutes as if it's the last 10 years. The antidote is simple. Pre-commit to what would confirm your thesis, what would weaken it, and what would invalidate it. Then let price do what price does inside those boundaries. But that's not the part that matters. The next detail is what flips the whole setup. The setup is that settlement control shows up first in the cost of liquidity, not in the headline price of an asset. If there's going to be a near-term tell, it will appear in the plumbing markets, offshore funding conditions, the behavior of USD CNH relative to broader dollar strength, the ease with which counterparties can source settlement liquidity, and whether spreads stay calm or begin to scream. So what does screaming up look like if you are not a bank trader staring at internal dashboards? It looks like persistent dislocations, offshore-onshore gaps that don't close quickly, sharp moves in offshore WAN that don't match the tone of other risk markets, unusually jumpy behavior around fixing windows, sudden policy messaging aimed at stabilizing expectations, and on the gold side, Moments where physical premiums or delivery tightness anecdotes rise even when paper price is choppy. You won't always get clean data in real time, but you can watch the behavioral tells. And that's where the real pressure starts. Now let's address the counterpoints head on because any serious viewer will demand them. Counterpoint 1, convertibility and capital controls. The RMB is not a free-floating, fully open capital account currency in the way the dollar is. That matters. It limits how comfortable global institutions are holding large RMB balances as reserves. It constrains offshore liquidity depth in moments of extreme stress. This can slow adoption. It can also make counterparties wary of being trapped. If China tightens rules at the wrong moment, it can reverse trust quickly. Counterpoint 2, rulebook trust. Settlement control is power, but it cuts both ways. If outsiders believe the rulebook is unpredictable, they will hesitate to adopt the rails for anything beyond necessity. And necessity-driven adoption is real, but it's corridor-limited. Counterpoint 3, network effects. The dollar system is enormous, deeply liquid, and embedded in decades of global finance. Network effects are stubborn. They don't collapse just because the alternative exists. That's why the realistic model is not replacement, but parallelization plus corridor capture. Counterpoint 4, geopolitical pushback. Building alternative rails can trigger countermoves, regulatory, diplomatic, and operational. That can slow institutional willingness to engage. That's why adoption often grows quietly through operational convenience rather than bold declarations. All fair. Now the rebuttal isn't ignore those. The rebuttal is the strategy doesn't require perfection. It requires optionality. Optionality is valuable precisely because systems are imperfect. A parallel rail doesn't have to be bigger. It has to be usable when the main rail is constrained. That's it. Now let's bring this down to right now, because macro talk without a near-term roadmap is just theater. The calendar trigger matters, because liquidity is not constant. Around month-end and year-end, dealers manage balance sheets more defensively. Funds rebalance, risk committees tighten, reporting dates change behavior. Thin liquidity makes moves sharper, and sharp moves force hedging flows which can create reflexive feedback. This is where market structure bleeds into price discovery. If gold is elevated and positioning is crowded in any direction, options can become the accelerant. You get short-dated gamma pockets where dealers are forced to hedge more aggressively as price moves. If price pushes through certain strikes, hedging demand can amplify the move. If price pulls back through them, hedging can accelerate the drop. That's delta hedging in plain language. Someone sold options, they must dynamically buy or sell the underlying as price moves to stay hedged. It's not opinion, it's math. And this is why trend can look like a straight line for a few sessions, and then snap back in a day. But that's not the part that matters. The next detail is what flips the whole setup. The flip is that settlement strategy and gold narrative can converge into a very specific near-term market behavior. When offshore dollar liquidity tightens, you can see a temporary squeeze in the dollar pressure on offshore yuan and a volatility spike across risk assets. In that moment, gold can do either of two things depending on which force dominates. It can dip as liquidity stress forces selling and the dollar spikes, or it can hold firm because the trust premium is rising at the same time. That's why you cannot treat gold as a one-factor asset. It's a collision asset. It sits at the intersection of liquidity, rates, fear, and collateral preference. So here's the two-scenario lens you should carry into the next week or two. Scenario 1 is the controlled pullback and retest. Gold cools off, chops, maybe retraces toward its most recent breakout zone or the last major weekly pivot, and then stabilizes. In this scenario, you often see the dollar firm but not explosive offshore yuan contained, and no persistent stress signals in settlement liquidity. The thesis doesn't die because gold retraces. A healthy market retests. What confirms the broader settlement control thesis here isn't gold ripping. It's continued quiet expansion of alternative settlement usage and continued corridor-level adoption. The market can digest while the infrastructure keeps compounding. That's where the real pressure starts. Scenario 2 is the continuation squeeze and gap risk. Liquidity thins, some stress pops, maybe around funding, maybe around geopolitics, maybe around policy surprises, and you get a sharper move. Gold either surges through nearby resistance zones in a way that forces hedging flows and triggers momentum buying, or it whips violently as the dollar squeezes. In this scenario, the key is whether settlement and funding signals show persistent strain. Dislocations last longer, offshore yuan behaves more nervously, and policy messaging becomes more frequent. This is where the unpack control of settlement story can accelerate because counterparties feel the risk of single rail dependence in real time. Now you asked for key levels, and we're going to do this without fake precision because the market will punish precision theater. Here is how to treat levels like an adult. Use the last weekly breakout zone in gold as your trend signal boundary, and use the most recent major swing high zone as the near-term resistance marker. If gold holds above its last decisive weekly breakout area on pullbacks, the market is telling you the trust premium is being defended. If gold loses that area and fails to reclaim it on a retest, that's a warning that the move was more positioning than regime. On the dollar side, watch whether the dollar index pushes to fresh short-term highs and holds them into the weekly close. If the dollar spikes but cannot hold into the close, that often signals a squeeze rather than a new trend. On offshore yuan, watch whether USD CNH holds above its recent range highs or snaps back quickly. Persistent elevation and jumpy intraday behavior are the tells of settlement liquidity stress, because if this one level breaks, the math changes. And here, it's the most practical what to watch next checklist without turning this into a lecture. First, watch funding tone. Not the headline rate you see on TV. Watch whether markets behave like liquidity is abundant or scarce. Scarcity shows up as sharper moves, wider gaps, and risk assets reacting more violently to small catalysts. Second, watch dislocations. When the same asset trades with persistent differences across venues or jurisdictions, the plumbing is speaking. Dislocations are the market's way of telling you that settlement friction is rising. Third, watch policy cadence. When officials start emphasizing stability, orderly markets, and confidence, it often means they're seeing pressure in the plumbing. Words aren't always lies. Sometimes words are a stress monitor. Fourth, watch commodity corridor behavior. If you see more settlement experimentation in energy and industrial commodities, that's strategic. Those flows are repetitive. Repetition creates habit. Habit creates default. Fifth, watch institutional workflow signals. Quiet expansions and clearing arrangements, settlement infrastructure, and interoperability aren't exciting, but they're compounding. That's the game. The market rewards compounding late and then all at once. But that's not the part that matters. The next detail is what flips the whole setup. Now let's tie the whole story together in one clear mechanism chain, because this is where trust gets built. China's goal is not gold makes us rich. China's goal is we reduce the world and its dependence on a single settlement rail that can be weaponized against counterparties, while building a parallel rail that gives us optionality, bargaining power, and corridor-level influence. Gold fits as a neutral reserve and collateral preference asset in a fractured world, but the higher control lever is settlement rails plus liquidity, backstops, plus governance. When you control settlement, you influence the cost of transacting. When you influence cost, you steer flow. When you steer flow, you accumulate network effects. When you accumulate network effects, you acquire strategic leverage without ever needing to declare victory. And the reason this matters for you as a retail investor or macro watcher is not so you can chant a slogan. It matters because these shifts change volatility regimes. They change correlations. They change which assets behave like insurance and which behave like risk. They change when gold acts like a liquidity asset and when it acts like a trust asset. They change how the dollar behaves in stress. They change how quickly local events become global. If you're trading yesterday's correlation map, you'll get blindsided. So here's the risk framing you need, stated plainly. Even if the long-term settlement control thesis is correct, price can whip around violently. You can have the right thesis and then still get wrecked by timing, leverage, or emotional decision-making. That's why you separate thesis from expression. You separate trend signal from noise. You plan for both scenarios, controlled retest and continuation squeeze. You define your invalidation. And you respect that markets can remain irrational longer than your margin can remain open. That's not fear. That's competence. Now, one more pressure point that most people miss. Settlement strategy also changes how crises propagate. In a single rail world, a blockage concentrates stress. In a parallel rail world, stress can route around the blockage, but it can also fragment liquidity, making volatility sharper in certain venues. Fragmentation creates opportunity and danger. Opportunity if you understand where liquidity is deepest. Danger if you assume one price always holds. The next detail is what flips the whole setup. The more settlement fragments, the more the real market becomes the one with the best liquidity backstop, not the one with the loudest headline. And that brings us back to gold one last time, because this is where the metals crowd needs to keep their discipline. Gold's role in this story is not to be worshipped. It's to be understood. In a fractured system, gold can become the asset that holds value across jurisdictions, the collateral language that doesn't rely on someone else's promise. But gold also lives inside a financial market with futures, options, positioning, and forced flows. That means you can get paper-driven volatility even when physical preference is rising. You can see a tape that looks weak, while trust demand is quietly building. That's why you don't let a one-day move rewrite your worldview. Volatility wants you to convert uncertainty into action. Your job is to convert uncertainty into a plan. So, final roadmap, near-term concrete. Over the next 1 to 2 weeks, watch whether offshore settlement conditions stay calm or start flashing strain. Watch whether USD CNH behaves smoothly or starts acting like a pressure valve. Watch whether gold holds its last decisive weekly breakout zone on dips or loses it and fails to reclaim. Watch whether the dollar S strength is a sustained trend into weekly closes or a squeeze that fades. Watch whether dislocations persist longer than usual. And watch whether policy messaging and operational expansions continue quietly in the background. If the base case plays out, controlled pullback, orderly retest, your signal will be the market defending key zones without persistent stress tells. In that world, the settlement strategy continues compounding quietly, and the gold headline crowd will oscillate between boredom and panic. If the squeeze case plays out, thin liquidity, sharper stress, more dislocations, your signal will be persistence. Stress tells that don't resolve in hours, but in days. That persistence is what forces behavior changes. That's where counterparties choose the rail that clears. And that's the subtle truth that makes this worth your attention. The winners in this regime are not the loudest predictors. The winners are the people who watch the plumbing, respect volatility, and refuse to be emotionally drafted into someone else's narrative war. If you're the kind of person who wants mechanisms over slogans, you're already ahead. Stay in that lane. Share your plumbing tells with the community, what you're seeing in funding tone and dislocations and cross-market behavior, because that's how we get sharper together without turning this into a cult. The gold story will keep grabbing eyes, but settlement control is what decides whose rules the market lives under when it matters most. And once you see that, you can't unsee it.